So we know that is the bull run becomes obvious to the masses when you start seeing it in public spaces, your TV and online. If it's still at the beginning of the bull run, you know there will be newbies or new people joining the space, and we call them newbies. No disrespect, it's just a short name for people who are joining it for the first time. They want to make a killing, of course. They all want to get rich overnight. They put their $10 or $100, they want to make $1 million. Unfortunately, it doesn't work like that, as you'll find out. But we've got some things that we want to share with such people, newbies who are joining the space. If you're one of them, or you think you haven't received proper education at a basic level, this content in this video is for you guys. But if you're from the UK, it's not for you. Why? Because the UK authorities do not like UK audience or UK participants, UK investors to participate within the crypto ecosystem. They deem it an extremely risky asset class, and you may end up losing your funds. And that's quite true. So you should only invest in crypto if you are prepared to lose everything. If you are not, this is not for you. For those from the rest of the world, while this is not financial advice, please treat it as entertainment as well as educational content. If you are not subscribed, please consider subscribing to our channel. And if you are a newbie or you are unsure of what it's all about, what you are supposed to be looking for, the steps you need to take to protect yourself and your investments, I've got a video for you guys. So we're going to start with things that you need to know as a newbie investor. You need to be aware of these things. If you are within this space and you're not aware of these things, you are probably doing it wrong, from my own experience, of course. So the first thing you need to know about the cryptocurrency space, without wasting any time, is market volatility. Cryptocurrency markets are highly volatile, with prices capable of swinging dramatically in short periods. Here I'm talking of 50% either way, up or down. It can happen, or you lose your funds from 100% to 0% within a week. For instance, Bitcoin has experienced daily price swings of more than 10% on several occasions, and recently we just had a 32 or 34% within 2 days or so. It happened with Bitcoin. This volatility can be driven by market sentiment, regulatory news, technological developments, or macroeconomic factors. So that applies to everything crypto. You need to be aware of those things. So understanding the inherent volatility helps you as a new investor to prepare for potential rapid price changes and avoid panic selling during downturn. And if you are one of the few who've got a crystal ball, you may be able to see the downturns before they happen, so that you exit higher and then come back when the price is down, so you can get more of what you had or buy something else. Not financial advice, of course. The second thing you need to be aware of as a newbie is the regulatory environment for this space. Cryptocurrencies are subject to evolving regulations across different countries, so check with your jurisdiction. During 2024, regulatory developments have been a significant driver of market sentiment, with countries like the US, EU, and China implementing stricter regulations on exchanges and initial coin offerings, or ICOs. Staying informed about regulatory change is crucial, as they can impact the market accessibility, legitimacy, and overall adoption. So just imagine you registering on an exchange, buying a token, and you are within a certain jurisdiction, and then access to that exchange is blocked. That's it, gone. So you need to be aware of that. You need to have some knowledge about the regulations that are governing cryptocurrencies within your jurisdiction or country. The third thing you need to be aware of are the security risks associated with crypto. Unfortunately, risks in crypto are rampant. It's a common thing, so you need to be prepared for that. The crypto space is susceptible to hacks, scams, and fraud. Major exchanges, for example, those who can go back to the early days of Bitcoin, we had Mt. Gox and CoinCheck, who have been hacked in the past, resulting in the loss of millions, in some cases billions of dollars worth of cryptocurrencies. New investors must be aware of the importance of securing their investments through hardware wallets if you can. I'll leave some links to the Ledger hardware as well as Trezor. I'll leave some links if you are interested. No, it's not a promotion. I just love those two wallets. They're my favorite. I know there's others, but I'll leave links to those too. You can also use hot wallets like your MetaMask and other such type of crypto wallets. Also make sure that you use two-factor authentication and understanding phishing scams to protect your assets. There is something new called social profiling, where people can create a profile using your IP address, how you interact with browsers, and so forth. So if you do not have good security for your browser, for your computer, and you don't practice two-factor authentication, please email and phone, as your two-factor authentication is risky. You need something else like your Google Authenticator or Microsoft Authenticator app. You need those. Phone and email, quite risky, okay? Because they can clone your SIM card on your phone, and they can compromise your email, and there goes your security. So be careful about that. The fourth thing you need to be aware of, guys, is the fundamental analysis versus technical analysis. You don't need to know exactly how it happens. You just need to differentiate between the two. Fundamental analysis involves evaluating a cryptocurrency based on its underlying technology, team, use case, and adoption. And that is what we cover here on Search5.tv. When we review a cryptocurrency, the project, we look at 13 elements, and then we give you guys a score to share with you what we think. If we're investing in that particular cryptocurrency, what is the risk level? What are we going to do? Are we going to stay out, or is it a go for it, or is it a no-go? I think we actually state that within the DIWA or risk evaluation toolkit that we use. So it's worth checking some of our videos. And if you got any cryptocurrency project you want us to look at, you're free to drop it in the comment section and we will review it for you. But that is just for educational purposes. You need to do your own research around what we'll present. Anyway, coming back to fundamental analysis versus technical analysis. Fundamental analysis involves evaluating a cryptocurrency based on its underlying technology, the team, use case, and adoption. While technical analysis involves analyzing market data, such as price charts and trading volumes, to predict future price movement. So you need to choose which ones you want to follow. If you are a moon boy, maybe technical analysis is your thing because you're receiving your dose of welcome every day, and it's based on technical analysis, of course, where they draw those squiggly lines. Understanding these two approaches will help you make informed decisions by combining short-term market trends with long-term growth potential. So short-term market trends is your technical analysis, but some people, I don't know whether that's correct or not, they use technical analysis to gauge long-term price movements, which I think is quite difficult. You can't do that. Technical analysis, short-term price movements, fundamental analysis, long-term growth of the project. So you need to choose. If your investment time horizon is long, then maybe fundamental analysis is ideal for you. But if you are talking of days, you're a day trader, or you want to swing trade, maybe technical analysis is what you need to focus on, or listen to people who do good technical analysis, not just some has-been. Okay? Be careful about that. So like I said, understanding these two approaches helps you make informed decisions by combining short-term market trends with long-term growth potential. The fifth and final thing you need to be aware of as a newbie or new investor is long-term versus short-term investing. Which one are you going for? Cryptocurrency markets offer opportunities for both long-term investments, that is holding assets for a long time, for example years, and short-term trading, taking advantage of price swings. So investing long-term in cryptocurrencies is quite risky if you do not understand the fundamentals or the fundamental analysis of a project. But you can't use technical analysis to invest long-term. That doesn't make any sense. Okay? Knowing the difference helps you as an investor to align your strategies with the risk profile of your investment and your objectives, of course. So those are the 5 things you need to know as a newbie. Now, 5 things you need to do, not financial advice, of course, but if I was a newbie today, these are 5 things I would want to do. Having gone through the journey, now I'm looking back, these are the things I would have wanted to be educated on. You need to spend time learning about blockchain technology, how different cryptocurrencies and blockchain networks work, and the market dynamics. Resources such as white papers, online courses, and reputable financial news outlets are valuable for gaining knowledge. Use Twitter as well and YouTube. A strong foundation in cryptocurrency basics enables better investment decisions and reduces the likelihood of falling victim to misinformation or scams. So that's lesson number 1, or that's to-do number 1. To-do number 2, you need to diversify your portfolio. You have no idea how many people have aped into some crappy coin and they lost everything and they start crying about it and they leave the crypto space forever because of poor decision. If you diversify your portfolio, you are spreading your investments across multiple cryptocurrencies rather than just putting all your funds into a single asset. This can include a mix of established cryptocurrencies like Bitcoin and Ethereum. There's nothing wrong with that. Yes, the returns might be lower, but you are reducing the risk of those ragging on you. And you can also include some promising altcoins like your shiny new thing and this special meme coin. For me personally, meme coin should not be part of your investment strategy, but I use it for different reasons. For example, I use meme coins to generate revenue that I want to invest in other things. That's my own approach. The next to do thing is you need to use secure wallets. Man, people get rugged. Store your cryptocurrencies in secure wallets, whether it's a hot wallet or hardware wallet, but I personally prefer hardware wallets, which are less susceptible to online hacks compared to software wallets or hot wallets. Yeah, the security is paramount in the cryptocurrency space due to the irreversible nature of transactions and the prevalence of hacking incidents. So if you lose your tokens, there is no one, in most cases, if it's fully decentralized, there's no one to contact to try and get your tokens back, even though you can trace them. But because everything is anonymous on a blockchain, you can trace them, but you won't be able to put a name or a face to to that wallet. There is the danger. Having said that, if you do your benefit risk analysis, I think your privacy and your anonymity online is more important than trying to identify who belongs where. That's my take anyway, if I were to do a benefit risk analysis on this. The fourth to-do thing is you need to stay up to date with market news. You need to regularly monitor cryptocurrency news, market trends, and updates from projects you are invested in. Yeah, you can check on their Twitter profiles, because most decent projects, they will have a Twitter profile. Some will have YouTube or TikTok and other social media platforms, but it's always good to follow them and see what's going on. I'll give you a good example. During the end of the last bull market, or at the beginning of the last bear market we just left, I bought into a meme coin, and it was flocking, and I just left it. I said I'll come back when the bull market starts. And when the bull market came back at the beginning of last year in about October, November time, I went there trying to sell because it had gone up significantly, and I just took my coins and I sent them to a crypto exchange to try and cash out, only for those tokens to get lost. Why? Because the team had issued a new contract. I wasn't following the social media. I couldn't claim it back. I couldn't get it reversed. It was just lost. Lucky enough, because of the way I do things, I sent 50% first because it was a big amount. So those 50%, I lost them and I kept the other 50%. So the other 50%, I think I ended up doing something on PancakeSwap. So I sold them via PancakeSwap. You could still sell them. So there you go. So you need to stay alert. You need to stay in touch. You need to stay close to the team that you invested in, their social media. You need to stay close to that. Okay? So being informed allows you to act and react appropriately to market developments and take advantage of new opportunities or mitigate risks. I just gave you an example. You also need to plan for the long term. Develop a clear understanding of your investment strategy with defined goals, whether it's for short-term gains or long-term holdings. Be patient and avoid making impulsive decisions based on short-term market movements. Again, guys, not financial advice. This is just education, okay? You make it what you can. This is just educational content. A long-term perspective helps you to ride out market volatility and benefits from the long-term growth of the cryptocurrency market. So all these dumps we're talking about, if someone, for example, the recent dump where Bitcoin lost 34% of its value and altcoins, they got destroyed. If you had gone away for say 7 days during that period, nothing will have changed for you. But if you were here watching the charts, you'll be panicking and selling and doing all sorts of things that are not right. That's not the way to do things. So that was the final thing you need to plan for. Plan for the long term. Okay. So I've covered things that you need to learn and things that you need to do as a newbie. Now, the don'ts, or things that you should not be doing as a newbie. Don't invest more than you can lose. Avoid putting your life savings or money you can't afford to lose into cryptocurrencies. The market's volatility can lead to significant losses. Cryptocurrencies are high-risk investments, and putting in more than you can afford to lose can lead to financial distress if the market moves against you. And most people, if you're a new, please do not play with leverage. That's not good. Experienced traders get wrecked. If you're new, your cheap meat will be eaten alive. The second thing, do not follow hype blindly. Avoid making investment decisions based solely on hype or recommendations from non-reputable sources. Research thoroughly before investing into any cryptocurrency. Most of the YouTubers, they are useless. They don't do research. Some will actually be promoting that token so that if you buy into it and the liquidity increases, they dump on it. So you need to follow reputable sources for your education. Hype often leads to inflated prices and can result in significant losses when the market corrects itself. Informed decisions based on solid research are more likely to be successful. Search5.tv, we do most of the research. It's all about education, less about the pumping part of your journey. So please join us and learn from us. Also, do your own research. Don't just go with what we are saying. You need to do your own research because this is your hard-earned cash. Do not put that into the hands of somebody. The third thing not to do is do not neglect security. Don't leave your cryptocurrencies on exchanges for extended periods. While exchanges offer convenience, they are also prime targets for hacks. That's number one. Number two, exchanges, for whatever reason, might decide to block you from withdrawing your tokens. The motive might not be based on good intention. They just do it. Maybe because they want to stop a certain token being overdrawn, so they'll block. No delays, or there is congestion. You can't delay. It happens either way, whether you're depositing or taking out. Taking out is the worst, because if you're depositing and it's not going through, you can either cancel the transaction if the time is on your side. But if you are withdrawing, you can't do anything until they actually say yes, you can. So be careful. Don't ignore that. Try and use secure wallets and implementing security measures like two-factor authentication, which can protect your assets from being stolen. And like I said, phone and email as a combination, that's not good two-factor authentication. You need at least a Google Authenticator or Microsoft Authenticator. I'm sure there are others out there that you can use, but email and phone, bad combination. Number 4, don't chase losses. What does that mean? Avoid the temptation to make impulsive trades to recover losses from previous trades or positions that you lost money on. This often leads to poor decision making and further losses. Chasing losses can lead to emotional trading, which is often counterproductive. Sticking to your investment strategy and being disciplined is more crucial than trying to chase losses. You actually can win. Again, guys, education, not financial advice. Number 5, don't ignore fees. Don't overlook the fees associated with trading, transferring, or withdrawing cryptocurrencies. You will know it if you start jumping in and out of the Ethereum network during the peak of the bull run. Some of us now have got our ways of doing things, so we can use a blockchain like Tron or Solana to transfer stable coins and avoid Ethereum altogether if your exchange supports that. Because Ethereum during peak, crazy. We're talking of something that became standard, paying a minimum of $40 just a normal day during a bull run, $40 to make a transaction. And I'm thinking, trade it fine. You don't pay that much. And here I'm paying $40 for, sometimes you're trying to transfer, say, something worth $15, end up paying $40 for it. Not worth it. So don't ignore fees. This can add up and eat into your profits. Understanding and factoring in the cost of fees helps in better managing your investments and avoiding unexpected losses. So the cryptocurrency market, as we enter the 2024-2025 bull run, remains a dynamic and volatile environment. By understanding the key risks, adhering to best practices, and avoiding common pitfalls, new investors like you, a newbie, you can navigate this space more effectively and increase your chances of success. And you are riding on our backs, on our failures. We made failures and mistakes in the past. Now we are dishing out the alpha. So don't miss the opportunity to learn from this. Knowledge, patience, and security are critical components of a successful cryptocurrency investment strategy. You heard it here first. Your host, FD for SafeFab.tv, dishing some alpha to newbies. Until the next one, bye for now.